Hello investors. In today's video we're going to cover this Canadian stock, but this stock also traded on US stock exchange. This is RBI, Restaurants Brands Internationals in short. We might not know by this the name, but for sure as a Canadian, Tim Hortons we all know. So basically under this brand there is a Tim Hortons, a Burger King and Popeyes. So these all three restaurant chains are under the same brand. So today we're going to do the fundamental analysis of this stock to see whether this is good for our value investors or not. Myself, Pramod Kumar, I am a CFA charter holder and FRM certified. So if I go to the pretty high level on the return on equity, then we can see this is increasing from 2015 to 2020, and now it's 14%, right? A little over 14%. So before we go to deep down, let me cover what I'm going to cover in this video. So I'm going to take the financials to understand how the company health is, and then I will go to see what the company debt is. Is the company is having the huge debt, especially on the restaurant industry? That's quite normal, right? But if the debt is too much, then is a problem. Then what I'll do, I'll use all the company's free cash flows and compute our stock price on this. Not only this stock price for now, for our entry price, but for the stock price also after 10 years, right? 2030. And then I will try to see, okay, if we enter into this stock price, what will be our return, right? That's what we will get. And then at the end, I will also share which other super investors have also invested in these stocks, right? And then we have concluded this video to see whether this is a good time for us to buy or not, right? So, and I'll also seek your opinion during this time. If you feel like you like the video, feel free to subscribe to the channel. I have a lot of stock valuation video like this where I do very deep stock analysis. Okay, and please give that thumbs up. Okay, if I start with the pretty broad level, so this is the 5-year chart, and we can see the stocks continuously to go up. And it was one time seems like over $100, right? And then this is a monthly chart and for the 5-year, and now it's right now trading at 78.49. so this QSR this price is on the Canadian exchange. In the US price, you just do the exchange, and it's a little bit lesser as the US dollar is stronger right now. As you can see, the company is making $2.36. This is the P is 33, around 33, and right, it's pretty much on, still has a room to grow. So seems like it's right at the between or a little bit over the average, right? It can go down or it can go up, depend upon the economic conditions, and we'll see what should be the right price. But the company is $36.85 billion, the company. That's the pretty much high level, and 303.92 million share outstanding. So that's what we have seen so far on the high level. Good thing is the company is giving the dividend, and I also show, okay, whether the dividend is increasing starting from 2017 on the quarterly basis, or it decrease. So how the dividend the company is doing, because as a dividend lover, we want the company to consistently paying the dividend rather than skipping it up. Okay, so let's quickly see some on the financials. So this is the company financial if we see the income statement, the gross margin looks pretty good. It's close to 70%, and the net profit margin is 17%. This is amazing for any fast food chain, right? So that's the top line and the bottom line, right? So that's amazing. After paying everything, the taxes and all, you have your net profit, and it's coming to 17%. And if you can see on the 2016 to this is 2019 yearly trend, the revenue is is growing. It's not like it's shrinking, right? That's the good point. And same as the net profit is also growing as the revenue growing. But if I see from the last trailing 12 months, because of the COVID, the revenue decrease on 12%. That's what it's. But not only this, but all the industry, you know, like a airline industry and the restaurant industry suffered from it. So but if we keep that aside, overall looks like the company is good on the margin. Similarly, on the cash flow side, when we see the annual growth, the cash flow from operations activity looks pretty very good as well. The company consistently able to increase the cash flow from its core business. And one thing I like to point out, and you see the cash from the financing activity, seems like company is paying a lot of debt there, and that I will cover in the separate slide how much right now the company debt is all have it. But that's what we have. So here now in this one we'll see the dividends history. So from as the company is paying quarterly dividend, as you can see, it's in December 14, 2017, the dividend they paid is $1.05, right? And it's 1.48% yield. And then on the 12-month trailing basis, this increased to 2.32. Overall, if you can see that in 2018 December, it was 2.40, right? And then increase, and then in the recent time, recent quarter, it's a little bit drop in terms of the dividend. But if you can see the good thing is the company haven't cut the dividend. But seems like in now the next dividend payment, which will be on January the 5th, 2021, is 3.57. So this means it's, if we see on the cent, is a very minor cut in the dividend, little bit cut, but still it's not bad. It's around 2.7, right, side. So good thing is if the company does well, the overall the company increasing the dividends. So that's the extra bonus. Okay, this is a slide. Basically, I just want to show you how the company is doing in terms because the company has three brands: Tim Horton, Burger King, and Popeyes. If we see the growth in terms of the restaurant, right, which restaurant is growing, it's pretty surprisingly for me to see as a Canadian, that because we love Tim Hortons, and hopefully all Canadian must be liking this video, smash that like button, right? So but the Tim Horton restaurant growth is quite surprisingly, when I'm seeing in their financial, is decreasing, right, from 2.9% to 1.8%, right? So that's pretty. And I don't know why then they make this franchisee of Tim Hortons so hard or so costly, but and the growth, even we see the growth is lower. Surprisingly to see on the Burger King, the growth of the restaurant growth, this means no new restaurant is coming that much, right, is also decreasing. But the Popeyes restaurant growth, it was increased, and then it's decreased in 2019 as well. So overall the new restaurant is not coming. And here you can see the major restaurant. If I see from the number perspective, the major one is the Burger King, right, and then Tim Horton on the number side, and the Popeyes. From the revenue side, the major revenue are for sure, you can see here, is coming from Burger King, and then the second place is Tim Horton. And my understanding is, as a customer, at least, I think if they should maybe more lean and open more Tim Hortons. And I see is opening, but it seems like that the growth is not that much. Okay, but okay, so that's what I want to bring it here. Okay, so this is quite this chart you might be seeing. Okay, so this is basically what is their analyst estimate of their earning going forward, right, which give us the future view. So future view is the next quarter of this is the 2020 last quarter. The analysts expect this growth for sure. The fast food people like to go out, but there's a restriction there, but at least for takeout people like to eat. And in January time, I think this is a seasonality effect and nothing bad, that the quarter 1 the people don't want to go out and eat because they have burned most of their bonus and cash in buying in December, boxing week's time and the Christmas gift and all. So but overall you see this is a uptrend in the projected by the analysts, which is a good sign here. Okay, now a little bit on the negative side, the company is keep consistently diluting its shares, so that's what I don't like it. So this is the number of share outstanding. You can see from 2015 it was only around 200 million share, and now it's even 303.8, which is not a good sign. Again, so I was reflecting you, I was talking about the debt, and if I show you how much the debt, so basically now the company has huge amount of debt, $11.98 billion, right? And then they categorize into this more senior or junior debt. So if I see from compare this debt to their operating cash flow, because that we can do some kind of a relative analysis, right? Okay, how much the company income is as compared to their debt. So you can see easily here the cash flow, what is in the blue line, is very, very small as compared to the total debt the company has. So this is honestly, this is not reducing, but this is keep consistent. So maybe that's one of the reason company is also diluting its equity. If that debt is not reduced, maybe the high chances company will keep issuing more and more share and get the money back to pay off its debts, right? Okay, so now I'll open the spreadsheet, and hopefully by this time you have already subscribed and liked the video. Will take the free cash flow, and then I'll find out what's the correct price if you still want to go and buy or this stock. Okay, so this is a free cash flow model. As you can see, this is a ticker, and the current price right now in the Canadian exchange, as you know, today was 78.49 cents, $1.49. So what I have done, I have taken the 4-year CAGR of 9.45% of the free cash flow growth rate, and then I have reduced it to 4.7%. As you can see, the company debt per share is coming around $72 per share. So it's a lot of debt, and the per share of free cash flow coming around $8. So this is, I have taken from 2000, the latest annual statement from 2019, and that's what I have got. And then this many shares outstanding. So what I have done, I just don't blindly take the 9.45 growth rate. What I have done in the next estimation of the projection of my free cash flow growth rate, I have reducing the growth rate year over, because that's a normal flow. Oops, maybe I should. Yeah, so I think, okay, so basically I am chopping the growth rate, right, year over year, as you can see here, because that's a normal pattern. Growth doesn't stops immediately, it's slowly every year it's dropped. So that's what I'm trying to do, and then I expect, okay, it's after 10 years it's be reduced to 4.73, and then I'll sell the company. So when I do this, and then I'm taking the 10% required return. For me, if I don't care any equity, especially this is not very risky, so at least I'll expect minimum 10% return. So that's my benchmark. Otherwise I'll just invest in ETFs or any other broad market index. So I use that 10% and discount to get the present cash flow. So this is on the per share basis. So when I do the math, I'll get the price now my price to enter is 69.59 cents in the Canadian dollar, and after in 2030 my price is 1110.96. If you sum it up, you might say, okay, even the 10 years was 69, how come you are getting this? Why? Because I have reduced all the debt, right? And then take add the cash flow. So that's what this model is doing. So assuming there won't be any debt, I don't want to pay debt, and then whatever, then from my future projected cash flow, I reduce all the debt, now have a clean cash flow. Whatever the cash flow is there, I'll just add and then get my per share price. So that's what I have done. So that's my two price. So let's take these two and then I'll show you what is your future return. Okay, so if this is my future return, so basically if I go right now and enter into this $78 which is the market price, because that's what I just go without waiting for the stock to move lower, then I'll got 15.76% return, because it's a free cash flow. I'm projected and get the cash back as well, right? So that's what I'm getting. But if I wait and seems like the price further drop because of Corona and other, if it drop, let's say worse to 48, I'm in a better position. I'll just definitely go and load up the stocks, and it will give me to almost 26% return, right? In a 10-year times. But then if I'll go and wait and the price goes up, then I have nothing to lose much, but it's still a little bit less, 14.21%. So that's what I am getting here. So this is the whole the matrix. Hopefully you like this, and please like the button. It takes a lot of time to make this kind of video. And I have one more slide before I close this video. Okay, so the Bill Ackman, is a very famous big portfolio. He invested in his portfolio 16.37% of his portfolio, and these many shares comes from QSR. So he has loaded the stocks quite well. And then the Prem Vatsa is there, who is a well-known investor as well, but in his one it's only 0.11 share. So now my question to you, what are you planning to do? Are you still going to buy this stock at the current price, or are you planning to wait to see? This is a dividend paying. For sure the next year it should do well, but you never look. The company has a fair amount of debt, as we can see. Or you just wait for the little bit pullback and then see if we can enter. Feel free to put in the comments, or any other stock if you want me to cover, yeah, and don't forget to like this video. Thanks for watching, and yeah, see you soon in the next video. Bye for now.